You go from a 60-40 to really, you get your core betas, and then you're going to add the 20% alts without sacrificing your core equities. I think the equity bond mix was somewhat straightforward in this combination that we're talking about. Like, we're doing some of the capital efficient core ideas with stocks and bonds, and a 5% position in the gold overlay. Then we have a little bit of more equities and sort of rounding out the bond futures you get with just the futures with some of the mortgages and investment grade. So it's a little bit straightforward of a equity bond mix, where a lot of the, I'd say, stuff that separates this model portfolio collaboration is in the alts, right? So I think we did a lot of work. You are first alts partnership in this space. So it's a big testament to, I think, all the work that you've done here, and that you're really thinking about this on a day-to-day basis, and that you've got a good track record running the alts. Let's go, boom.
Hello, everyone, and welcome back to What's the Alternative? I am Shana Orczyk Sissel, founder and CEO of Banríon Capital Management, and this is the podcast where we dive deep into the weeds of alternative investments with leading experts. Today, we have a great guest. I'm super excited about this particular guest because we have some really cool things that we're going to be announcing as it relates to their firm and our firm. I have with us Jeremy Schwartz. He is the Global Chief Investment Officer at WisdomTree and has been since November of 2021. But he's been with WisdomTree since 2005. And as he informed me right before we went live, he is the second longest employee at the firm other than the CEO. So welcome, Jeremy. I'm so excited to have you.
Shana, I always love doing these podcasts, particularly when we have some news to announce. So this is great to be with you. Thanks so much for having me.
Absolutely. Super excited about it. All right. So let's just get started. I'm really excited to have you on because as some people know, but we haven't publicly talked about it, WisdomTree and Banríon have teamed up to put together a open architecture alternative ETF model that's part of a broader program that WisdomTree is launching involving return stacking. And I talk about return stacking quite a bit, but the term is a fairly new one. And I would love it if you could kind of walk us through WisdomTree's thought process here, the commitment to the space, and how alternatives fit in.
Yeah, and I think in the active world, you've seen the use of leverage and these kind of strategies for a long time. I know, there's been actively managed bond portfolios where they try to add some returns on trying to get short-term fixed income, and then they layer on equity swaps, and they're just trying to outperform the funding costs of the swap or the future, and that's how they add 1-2% of quote-unquote alpha on top of equities. That's been done, for a long time. There's other combinations where they combine that type of concept. We were the first firm, I think, to do it with beta instruments, using basically stock and bond futures. So 7 or 8 years ago, a lot of it generated from a conversation that I saw on Twitter back in the day. So a few anonymous people and Corey Hofstein were talking about, hey, there needs to be innovation in ETFs with leverage where you can provide these betas in a stock and bond mix. And there was a conversation about what's the optimal ratio, but the conversation went to 90-60 or 1.5 times a 60-40. And that original idea was 2/3 of a 90-60 gets you a 60-40. And then you have 1/3 of your portfolio freed up for alternatives. It's well, if you're going to put in an alternative, where do you fund it from? What do you sell? You're putting in this sort of complex instrument. It's always tough to figure out what to sell. And this was the idea where you could have both, where you could do that. And so we launched 3 versions of that, sort of US, international, emerging. We probably have combined our whole suite, probably over $2 billion in the concepts. We later did gold with gold on top of things like large cap equities and more of a 90-90 conversation. And it'll be maybe one of my favorite days in my 20 years of history is when we first launched it. The day we launched it 7 or 8 years ago, we put it out and Cliff Asness wrote out, I had a 25-year head start on WisdomTree and they still beat me to it. And so it's been a nice relationship with Cliff, who actually wrote a paper in 96 where he had 70 years of history looking at the leverage 60-40 doing better than 100% equities. And his leverage ratio in that paper was like 1.55. It was like exactly the 90/60. And so he was being very gracious. So we, further went back and looked at his research, extended it, and said, yeah, a lot of research fails out of sample, but if you were to do his research in the 30 years since he published the paper, it's worked better in the actual 30 years after he publishes. Not only did it fail to it did better than failed to replicate it. Like more than replicated. It did better, and so that's been great. It's been a fun family, and I do think you're seeing it. The gold stack, you could say, the gold capital efficient idea is doing incredibly well in the last few years. It just is another asset where it's like, well, what do I sell to add my gold? And if you don't have to sell anything, that's kind of a best case scenario, I think.
Yeah, well, first off, it's nice to meet a fellow fan of Cliff. I would love Cliff. And you did mention Corey Hofstein. Corey Hofstein, we had on our podcast a couple years ago, and Corey kind of walked through this idea of return stacking, and he's launched some ETFs that do that. And we have a client, Rareview, who you're familiar with, that is doing return stacking with Bitcoin and ETH. As well as gold and silver in their BEGS ETF. And so the idea has come through, and a lot of talk it's about leverage, right? So levered ETFs are not new. There's been these 2 times levered, 3 times levered, short levered ETFs. And those ETFs are different in how they use leverage.
Yeah.
Can you walk us through the difference? Because leverage gets a bad rap, but like there's good leverage and there's bad leverage. And we use leverage every day because if you borrow anything, you are using leverage. But there's all different ways to actually implement leverage in financial markets. And some of it actually adds risk and some of it actually removes risk. Can you kind of walk us through how you look at the different ways to lever a portfolio?
Where they really got a bad rap was around the financial crisis. It started with that. And there's a lot of the funds that are in the market are 2 times. Now there's 3 times. In Europe, they have 4 or 5 times. But the idea is daily 2 times. So yes, it replicates 2 times on a daily basis. But if there's a lot of volatility in the market where people got misaligned, it's like, hey, these are 2 times your daily return. Path dependency matters. And so if you have a big volatile downswing and these try to do 2 times, they sort of you're sort of lowering your exposure. So it's not 2 times a long-term period, it's 2 times your daily period. And so, in a trending market, it could be quite good. But when there's volatility around things, it doesn't often lead to 2 times the long-term experience. It's 2 times the daily experience with good predictability, but that path dependency really matters. So most of those funds are using swaps. We are using futures in the funds that we have today. Some people have said they like some of those other like bond type ideas in their taxable accounts, and they use ours in sort of in their tax deferred accounts because they're less good income promoting equities versus ours is when you own core traditional equities, then you add bond futures. That might be a better tax feature for some of the bond sides. So people are using our capital efficiency and some of the more taxable ideas and maybe some of these other active funds with the swaps on non-taxable accounts. But it's that longer term, the futures is one of the very efficient ways of cost of getting leverage is basically short-term interest rates is the cost of the leverage. And, but it's a very efficient thing. We tend to roll them quarterly in the bond funds with the NTSX, NTSI, NTSE family, where those are U.S. international merging for the 90/60 concept. Mm-hmm. We're essentially doing a bond ladder that represents the ag, the bond, the Bloomberg.
What is it now? The Bloomberg ag. It's not the. Is it?
I would say the
Bloomberg Barclays aggregate or something like that.
And now the Bloomberg, the Bloomberg bond benchmark. So the major bond benchmark duration. We're trying to get a ladder of futures that gets you representative of the duration of the total bond portfolio. And and that rolls quarterly, and we go back to the 90/60 generally on a quarterly basis. If it moves beyond a 5% band, we'll also look at bringing it back to like the 90/60 level. But it's very different than the daily resets, and a very simple way. I mean, we now have 8 years of doing it in real time with NTSX. You could plug in your favorite cash vehicle, like we have a fund USFR that's floating rate treasuries, and if you did 2/3 NTSX and 1/3 USFR, it'll give you basically exactly the 60/40. Mm-hmm. So you can see that it works out and checks out. So like the idea is if you could do anything that beats cash, you're better off.
Right.
And that's the original idea, is if you could beat cash, you're better off. But even just having the flexibility to get the 60-40 and have the cash, that also has been another place where people have thought about it.
Yeah, I think that's really interesting. You mentioned using futures to replicate the ag. And I think a lot of people don't realize that no matter what you're investing in, if it's an investable vehicle, it's a replication of the ag. That's the bond benchmarks you really have to replicate. So, what the underlying is, I think, is the interesting part. But ultimately, the replication of the ag is not an unusual thing. And then with the S&P, it's pretty easy to use futures to implement that exposure in your portfolio as well. Now, WisdomTree is known for the fact that they do some creative weighting, right? The whole concept behind what WisdomTree started as was that there was inefficiencies and the market cap weighted aspects of the indices. How are you implementing that in the portfolios that you're building?
Yeah, so you're right. Like, when that goes back to my work with Professor Siegel, and when they were first funding the firm back 20 years ago, was everything was market cap weighted and rebalancing. Something rhymed with today. Like, Siegel was doing research post tech bubble, and his op-ed, big cap tech stocks were suckers bet in March 2000. A lot of people say it's today like that. We say no, it's not like that. There's a lot of big differences between today and back then. But there was an idea of how do you protect from bubbles, how do you rebalance on a fundamental discipline. And in '06, we launched 20 funds in one day that were all rebalancing back to dividend streams.
Mhm.
In the models that we're working on with you, I mean, the capital efficient idea is the core. So these are not meant to be that fundamental. It's really broad equity and bond beta. We're doing some models with a little bit of gold in them as well. So you get the gold in a capital efficient way. But we're using some of, I think, our best value and growth funds as well. We launched something that's more shareholder yield focused, dividends and buybacks. I think when people say the markets are expensive, these companies today have like a 7.5% buyback yield and a 13 PE. Like, S&P's at 23.5. This is not an expensive set of stocks in that fund, but that's tied to that fundamental view of trying to get towards value. And then we did evolve and not just do value. We have some, we think, improvements on growth and quality. A lot of our research is focused on the quality factor starting over a decade ago, and taking some of the latest academic research on buying intangibles and the investment in R&D that a lot of these big tech companies are doing gives you better measures of profitability. That strategy has been out 3 years in the market and has been able to outperform the NASDAQ, which is one of the toughest benchmarks to beat in its live 3 years. So both of those are like the core and value or value and growth segment of complementing just the capital efficient core. And then we're using your alt model. So you blend in alts, and you're going to get a better place where you're using stocks and bonds and a few other open architecture things on mortgages and investment grade to round out a holistic set of stocks and bonds. And then we come to you for your best ideas in the ETF alternative world.
Yeah, and that's the interesting thing. I always talk about this, and you and I have talked about this. We do a really good job teaching advisors how to build equity portfolios and fixed income. It kind of is intuitive to them. It's kind of what you learn when you start. But all this is different. And so when we kind of talked and we're thinking about how we could work together, the goal was to provide like a fully diversified, non-correlated or low correlation portfolio of things that you could put in your portfolio that to your point earlier, where does it come from? I've always kind of been through the thought process that you have, but it's not nice and pretty clean percentages. I always say if you have $1 million to invest, you put 800,000 in the 60-40, you take 200,000 and put it in alts. That way you're not just deciding where it comes from. But in the return stacked scenario, you don't even have to worry about that. You get your 60-40 and then you have your alts bucket. And the goal, of course, is to provide alts exposure, but with the knowledge that I bring to the table, it's about also being tactical with it. So, there are some alts positions like managed futures that are fairly defensive. And then there are others where you can take a directional bet where you have like a long short equity that can, extend the exposure to the long book and not have as much short in good markets, and therefore be able to potentially add alpha over a full market cycle by just being tactical with the allocations. We have Bitcoin, and we use the WisdomTree Bitcoin fund in there. We have BEGs, which is the levered version of crypto, and some of those metals that we talked about. The goal, again, being is that you can have alts in a portfolio and it doesn't have to be a drag on performance if you're tactical about it, but you got to be smart in how you build it. You're not going to make just a bet on any one of those things. You want it to be a smart portfolio the same way you would build an equity or a fixed income. We're not, or I don't think I'm smart enough to know exactly where the market's going to go in a year from now, but I do know that I can tell from momentum if we're leaning into risk or out of risk, and having the ability to turn things up and down is kind of the key. The greatest thing about WisdomTree is that you are open architecture. You have phenomenal ETFs on your own, but you also are willing to say, there are places where we don't have the best products, and we're going to open up our models to include both WisdomTree and non-WisdomTree products. And that's what we've done with the alt model too. There are just some areas of the market where you got to have specific expertise. You talked about Cliff. Cliff stays in his lane. He's not necessarily building out, index models of the S&P. His knitting is as a quant guy that has been running long short books for the vast majority of his career. And that's what you see it from AQR. And so that willingness and that openness, I think, also makes it really attractive to the average advisor. And maybe you can speak to that. When I talk to advisors and when I was working as a CIO for an advisor, I honestly hated having a model that was just one fund family. If clients look at that and think, like, what's the incentive? We would look at models from a fund family and then switch out a couple of funds with a fund from another fund family because we liked the model, but we didn't want to seem like we were tied to that fund family. And WisdomTree kind of makes it even easier for the average advisor. What's the feedback you've gotten from advisors in your approach?
Yeah, I remember the day we first launched it, well over probably a decade ago. I probably got a call from one of our top clients who's like, "Why are you now competing with me?" And they were an ETF strategist, and I said, "No, no, 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 no. We're just trying to give people on paper some ideas of, you know, how to implement our funds." And to your point, it was like 100% basically WisdomTree model. I think when we first started on Decade, it wasn't implemented anywhere. It was just a paper model to give people some ideas. And the world's converged. Now that firm has ETFs. It's a converging world. But I do think we are trying to give our top ideas of how to use things within our family, but without, like you said, because people don't just want one solution. They want to see that you're thinking across the industry. I think one of the feedback points, we now have been doing this, not, in terms of implementing it in real time for people, probably 5 years. And we probably about 5 billion in this type of model framework. But I think we're investing a lot in this business, and we just made another strategic investment in a company called Quorus to help implement these things. So I think one of the hard parts also now, Shana, and we're co-managing a model in a way where we've got this part, we've got a co-branded model. Like, well, what do I do with that information? How do I get it done? How do I execute it? And we do have with Quorus a group that could execute it very efficiently for people. We are feeding them all the monthly signals and the monthly portfolios. They will help implement it for people very, very efficiently. And so I think that's an exciting part of the partnership as well, is that basically through the Quorus platform, it can get implemented seamlessly.
Yeah, and I actually was going to ask you about that next, so you beat me to it. But I think that that's the key. When I was a CIO at an REA, we did implement models. The problem is you usually get the model information after they've already traded it. And so you're not necessarily getting things in real time, and how and when you trade matters. And when you can use a platform like Quorus and just kind of leverage that to kind of implement and make these changes in the model in real time, I think that's the key, because a lot of times that matters. Because when I send a report to WisdomTree, or WisdomTree sends a report on what the collective model is doing that we track, because we don't necessarily know how it's being implemented on the advisor side. One of the things we would run into when I was a CIO is we didn't match. Well, we didn't match because we weren't trading at the same time, and those things matter. And also the efficiencies of those trades matter, because the cost of trading does eat away at your excess return over time if it's not done in an efficient way.
Yeah, and I think Quorus started as the founders came from Vanguard, so they helped build the direct indexing platform at Vanguard. So they have a lot of experience in the space. They're going with an interesting value proposition because everything's focused on direct indexing.
Mhm.
There's not been a lot serving the active community, so I think they're trying to bring the tax efficient portfolio management towards more of an active audience. But for us, and we made the investment, some of it was about helping us get into direct indexing and doing that a bit more. And we do have a bit more active strategy. So you have to be thoughtful, special considerations if you're doing something that has rebalancing, because, rebalancing is about, will create more capital gains, maybe make you tax inefficient. So you got to be very thoughtful on how you do all
Mhm.
that. But for us, it was also equally about making this model management. It was an investment in our models business to try to bring this, again, as I say, with very, very little friction for the advisor and very cost effectively for them. So I think as we talk to people, you'll see it's a very compelling way of getting access to Shana's best ideas. And alts are in sort of blending with the core capital efficient ideas and some other rounding out positions. And it could be easily available on Schwab, Fidelity, some other platforms in a very simple framework.
Yeah, and as somebody who ran direct indexing portfolios when I was at Orion, I can tell you that tax part of it is a lot harder than it seems. We were using Astro, which was a optimization tool that I helped build. I led that project. I don't know that Astro still exists. I think it kind of came and went, which makes me a little
Mm,
sad because we spent so much time on it. But one of the things we would run into is, it matters how often you get your data. A lot of folks aren't paying for like minute by minute information on the market. And when you're doing direct indexing through a tool as an advisor, if you aren't paying for that, or you don't have a tool that has the minute by minute market movements, you are making decisions from a tax efficiency standpoint and a trade standpoint based on stale data. And then it gets executed later in the day, and you have no idea. It's not being executed in real time. That can be really problematic. And we ran into that a lot at Orion, which
mm,
was, we would look through the portfolios, make the trades based on the previous day's close, and we'd put them into the system at noon and they'd be executed at 2. And then suddenly what we thought was an efficient trade or was a trade from a tax standpoint, it ended up not being it because there was so much time that passed and the market moved so much. So having tools like Chorus, I think, really help that. And then just as managers being thoughtful ourselves about how much we trade within the portfolio,
yeah.
understanding that, you know, active ETFs, it's a little nuanced, but in general with ETFs, your tax consequences happen with the trade, not necessarily with the underlying activity within the portfolio. And that matters. And so, at least on my end, I try not to make a lot of changes. Maybe turning up or down exposure at times based on broader market trends and my thoughts, but really trying to stay and not make a lot of trades, which I think also makes the advisor's life a lot easier. And using tools like Chorus, I think that's true.
Yeah, with alternatives, sometimes the tax, it's a little sometimes not the traditional plain vanilla
Right.
equities or plain vanilla bonds. Like when you're using futures, ETFs are very good. The deep mechanics of ETFs, they're very good at rebalancing. So I have a U.S. equity portfolio. I've been running it 20 years, basically never paid capital gains, right? It does rebalancing every year, 20% a year, but doesn't pay capital gains. That's because of the creation redemption mechanism, the way they rebalance.
Hmm.
You can do things very tax efficiently. What they can't do is change the taxation on things like forwards or futures or swaps. If you're using instruments beyond the what can be inkindable, they sort of
Hmm.
create redeem where you can swap baskets of the ETF for the underlying. You can't change the taxation of forwards and futures. So if you're using that in funds and a lot of the alternative funds and our capital efficient funds, you use futures, you will get 60-40 taxation on some of those futures, and some of the other things they have more rebalancing within them. They'll have more distributions, but that sort of comes with the territory on those ideas.
Yeah, and that's just active ETFs in general. And a lot of people I don't think understand the nuance that unlike traditional passive ETFs, yeah, active ETFs do have some tax consequences even if you're not trading them. But we can be thoughtful in the selection of what we're using and try to minimize, what we have in the portfolio that does that. So if you look just at the underlying of the portfolio we put together for WisdomTree, you know, BTOL is not necessarily using futures and forwards. They're actually shorting stocks. There's some consequences to that, and some of their expenses get a little funny, and you got to start looking at the prospectus to get like the reality of it, the situation. But that isn't using futures and forwards per se. And you look at something like Cloud Capital, their CBLS fund, they're not necessarily using futures and forwards, they're actually shorting stocks. But you got Begs, which is using futures and forwards, and you're thinking about, how do we fit these in and try to be tax efficient? But using a tool like Quorus can really help with that, and just making the advisor aware, because I don't know that a lot of advisors understand the nuance of the active ETFs and the tax consequences. They just automatically think, oh, well, an ETF is more tax efficient than a mutual fund, which is true, but active
Yes.
ETFs are, a little nuanced in that respect. So let's talk about kind of how you do your research and how you determine what products get put in the portfolio, what makes sense, and how you optimize it. I love, as we already pointed out, that open architecture. I came from Fidelity SAI, Strategic Advisors Inc. I think that's what the I stands for. And that is an internal group at Fidelity. It's an REA, and they manage open architecture funds, and for the mutual funds. WisdomTree does that a lot with the models that they do as well, along with their own products. And WisdomTree has some great products, as we've already touched on. How do you do your evaluation of outside managers? Because I think that that's a really important aspect to what you guys bring to the table.
Yeah, and well, in this one, one of our big diligence items was finding the right alt partner. So you helped us solve, because we have almost 10 different alts line items in this book, and this sort of new model portfolio collaboration. So I think that's what was some of the most complex. Think about that. When we said you could go from a 60-40 to really, you get your core betas, and then you're going to add the 20% alts without sacrificing your core equities. I think the equity bond mix was somewhat straightforward in this combination that we're talking about. Like, we're doing some of the capital efficient core ideas with stocks and bonds, and a 5% position in the gold overlay. Then we have a little bit of more equities, and sort of rounding out the bond futures you get with just the futures with some of the mortgages and investment grade. So it's a little bit straightforward of a equity bond mix, where a lot of the, I'd say, stuff that separates this model portfolio collaboration is in the alts, right? So I think we did a lot of work. You are first alts partnership in this space. So it's a big testament to, I think, all the work that you've done here, and that you're really thinking about this on a day-to-day basis, and that you've got a good track record running the alts. And I think, plugging that into sort of simple stock bond executions, like the predominance of the risk is those capital efficient core ideas, and then we're blending in with some of the value growth, the two value growth ideas I mentioned. But those are pretty straightforward, well tested concepts of getting a good value growth anchor to portfolios. And then, so the real extra thing that separates out our collaboration is the alt side.
Yeah, and you mentioned this, but I've been running an alts ETF model since my days at CLS, which is now Orion or Brinker. But one of the things I started doing in 2007, I don't know how many people know this story, and you probably do, because we've been on stage together for a long time, and you've heard me talk, but I started building alt portfolios of ETFs and mostly mutual funds at the time in 2008, because I had just come from Russell, where I was working on their hedge fund to fund, and I was really compelled to, like, why can't we offer this to non-accredited investors? Like, there's got to be a way. So I would build an alts portfolio of, the non-liquid private placements, and then I would try to replicate it. And at the time, there were a million mutual funds that were doing alt stuff. A lot of them have gone away because they never were able to gather assets, because it was mostly hedge funds trying to get into the space and then realizing, oh, wait, distribution's different. But now that we have active ETFs, I think that having that background has really helped me be able to identify the right names and how they fit in, because I am coming at it with the knowledge of what the private side is doing, and then finding things similarly in the public side. But also, the categorizations of these things is wild. Like, they are not categorized in a way that is easy to identify, like how they'll fit in together. And that's a really important component. Like, you talked a lot about like how you build the futures ladders and how you think about putting the equity together. I spend a lot of time thinking about like what alt fund belongs in this portfolio, because it might look good on its own, but I'm saying everything has to be done in a portfolio setting. And maybe you can speak to that. Like, I don't want to, this is, I really want to focus on what WisdomTree brings to the table, because I think you guys do it well. But I don't know that a lot of people really think about the fact that when you build a portfolio of funds, so in this case, an ETF model, or even like individual securities, like you guys are doing in the futures and that kind of thing, you really got to think like everything is not in a vacuum. It's everything how it fits in a puzzle. And something may look good on its own, but when you put it in the mix, it doesn't bring what you need to the table. So there's an art to this. Would you say that that's
Yeah.
true? And how do you approach it?
Yeah, I was just listening to another podcast over the weekend talking about this 60-40, and this person with big major firms, he was talking about going to a 50-30-20, sort of exactly what we're saying, where you sell some stocks, you sell some bonds to fund the 20% that goes in alternatives. And our model collaboration is also doing 20% in alternatives, but it's not sacrificing the core stock and bond. So this is a classic example of the capital efficient core in motion, is that we're going to help people keep the standard 60-40, but poured on the 20% alternatives, quote unquote, as a additional overlay without having to sacrifice their core. So it's a beautiful collaboration from that perspective, and it's our first meaningful collaboration like this on a capital efficient concept. So to me, it's a very exciting launch, and for people to be able to get access to it through Quorus is as Quorus is rolling out the model trading with us. It's also very early collaboration days for Quorus. So it's an interesting new example of how to use these new tools in portfolios.
Yeah, well, first off, thank you for believing in us and bringing us this opportunity. I don't even know, what did you guys land on for the name of the product? Because you guys sent me a bunch of, I think there were like 3 that I really liked. Which one did you guys run with? Because I don't even know the answer to that question. Live on the podcast, we're going to unveil, what the name was. Did you guys decide? What did you go
I hope
with?
I get the pronunciation of your firm close. But WisdomTree Banríon Select Alternatives Model is
Perfect.
the,
Yes, and
yeah.
you got the name perfect, so you didn't screw anything up.
There
So
you
I want to dive a little bit into your background, because doing what you do is, most people in our business, you're traditional, right? You're an equity guy, you're a fixed income guy. You have some people that run around the edges and like do the portfolio management, the balance stuff. But you guys really do something different, and your background is really different. Can you kind of walk us through what it's
Yeah.
been like, and your background, and also what it's been like to work with Professor Siegel, because that's a tremendous opportunity, and I'm sure you've learned a lot.
I sort of grasped onto him and never let go. So I met him, I was there at Wharton during his heyday. Like when he wrote Stocks for Longer in '94, and he viewed as like the father of the bull market for a lot of that. And he basically gave Vanguard a lot of free publicity, just saying, I believe in low cost indexing, buy the market, buy beta. People would call him and say, what stocks? I don't do that. But where he really had a strong view, he started writing about it in '99 and 2000, and became very famous. And I was at Wharton in his class when he was he had that op-ed, Big Cap Tech Stock or Suckers Bet. And so I got to meet him through a program called the Dean Advisory Board. Patrick Harker, who was the Fed president of Philadelphia, he was the dean at the time. And I got to meet him and got to take his class after that, and needed something to do for a summer before I went abroad. And one thing leads to another. I don't go abroad. I take off 2 years of school to work for him on the 3rd edition of the book, and then his next book, The Future for Investors. And so I sat in his office and heard every conversation he had for 4 or 5 years, which was, an unbelievable experience. And he was a 7-day-a-week kind of guy. I showed up on a Friday for my first day, and he said, I'll see you tomorrow. And that was the mentality of every day we were on, for, the time I sat in his office. And so yes, he's been a huge mentor, and, gave me, really taught me everything about the markets. But, WisdomTree, we joined, they were getting funding in '04. Jonathan Steinberg, the CEO, had this idea. He had a publishing business, a magazine. He was trying to emulate McGraw-Hill, who had publishing and indexes, trying to launch the ETFs. And Siegel ended up investing in the company and becoming an advisor, because it synced up with all the work we did for his second book, The Future for Investors, that was about sort of solving for bubbles and rebalancing back to fundamentals. And there's a lot of independent research that what we were doing writing the book was very much at the same time as Jonathan was launching the company, and it was supportive. And so we joined, they brought me on. So when you come as a startup, like we had a white paper, and I wrote the first white paper, it was 80-page white paper at the start. And I did all sorts of back tests of the original idea, and um, and really have been just a part of all the product creation and process over the last 20 years. So today, my remit is beyond equities. We've gone from equities to bonds, but we have a CIO of the fixed income team. We have a CIO of the model business. We do in Europe commodities, crypto. So it's really every asset class that you could think of that sort of in some ways rolls into my purview. So it's definitely been an exciting place, and I think we try to push the envelope on new ideas.
I have two great Professor Siegel like stories. First is the first time I ever saw him speak. One of my favorite memories in life was I think the 2008 or 2009 SALT conference when it was in Vegas, the Skybridge event, Anthony Scaramucci's event, and it was the first time I'd ever gone, and it was him and Nouriel Roubini doing like a debate, which was phenomenal because they're so strong personalities and they have such different views of the market. And it was like going to a prize fight. It was epic. And that really made me notice him. That was the first time I'd really been exposed to him. But then just about a year ago, I was at a conference that he spoke at, and I had Connor Lapine, who is our investment associate. He's still in college. He was an intern for us first, but he's just like, we can never part with him. He's the best thing that's ever happened to us. I tell him this all the time. So he goes to college in Texas, and the event was in Texas, and Professor Siegel spoke, and I went up and introduced myself to him. And then I introduced Connor, and then he took the time to really sit and talk to Connor and ask him about school and what he's working on and what he was thinking about. And the impact that made on a 21-year-old kid, and I'm sure you can speak to it because it sounds like it was similar to yours. He's just such a nice guy who's willing to teach. And I think he really enjoys helping that next generation learn and challenge markets and the status quo and really think for themselves and think critically about these things, which I think is what makes him such an amazing person. You can't
Yeah.
believe what it must have been to be mentored by someone like that.
Yeah, he loves teaching more than anything. Like he obviously could have gone straight to Wall Street and done all sorts of things, but he had his. I think what made him a great teacher at Wharton was his connection to Wall Street. Like he would present at like J.P. Morgan's annual, basically training program. He like designed their training, their economics training program from back in the 80s and 90s, and he would every year would do things like the SIA, the Security Industry Association, would have their big thing when the kids went on spring break, and he would do a week and would be the leader of that program and would constantly get feedback from participants. And and obviously WisdomTree had a big relationship with it the last 20 years, but he wanted to be full-time a teacher, right? And what he enjoys most is that teaching them. And he does a lot of presentations with us talking about the markets. And we do a podcast every week, and it's partly because he's just so used to, in his class, he would think structurally about what's happening in the markets. How do I relay it in exactly a place? And when I was in his class, they were standing room only for people to come in. And his first 30 minutes would just be talking about the markets with the Bloomberg screen up. So, he's loved the markets and tried to explain the stuff in his class, which is an economics and financial markets class, is explaining the theory with the real world, of like what's actually happening and then how you tie it back to the lessons. He just loved that so much. And that's why he kept doing. He did become an emeritus professor, so they do try to move you on after you get to a certain age at Wharton. Yeah. But he's extended it 5 years past the normal, and but now we keep him very actively engaged with WisdomTree.
I do think there's something to having so I took economics in undergrad and I took economics in grad school. No shade on my economics professors in grad school. I'm sure they're all wonderful people, but like they weren't compelling. I didn't have the passion for it. And I didn't feel like I got from them. I had, like you, nowhere near Professor Siegel's like cachet, but I did have an undergraduate economics professor who, as you're talking, I'm being reminded of Professor Resnick, who Resnick and Wolf is like really famous economics. They did a lot of work on Marxism. I was very fortunate to he was my economics professor for all of my economics classes. He unfortunately passed away several years ago, but when you get to learn from somebody like that, who's got that passion for economics, which by the way is not necessarily the most interesting subject if you don't have the right professor, like it just helps you grasp some of these really complicated ideas that are really just a lot of theory, because not a lot of it
Yeah.
actually works out in practical application. But when they can take the theory and first acknowledge that these things don't always work the same way, but then show you kind of how to take the theory and use real life examples and then how things play out in real life, I think there's real value to that. And there's having a good economics professor is like the key to being able to understand the markets going forward. And I'm forever grateful to have Professor Resnick, even though, different view of the markets, but still, one of the greats in the world of economics. And that, as you're talking, it's just reminding me of him. And he's been gone for a while now. So, it's kind of nice to bring his name up. But, why don't you tell us a little bit more about kind of what's next for WisdomTree? You've got these great models. How can people access them? How are they being rolled out? I have some insight into this. I'm super
Yeah.
excited about this, but where can people find out more information about the models, how they're rolling out, and more importantly, if somebody wants to learn more about Quorus and how it's working with the model implementation, where can they go to find that?
Well, I think certainly Shana could help direct to Quorus. I could help direct to Quorus. So I think good starting point is with us. If you have, or if you have a WisdomTree contact, for sure, our team will make all the right appropriate connections. If you know people on our team already, Quorus John Hill is the CEO. You can find him, I'm sure, on his website, LinkedIn, Quorus. I think I'm getting that spelling right.
Yeah.
Quorus is their platform name. You can look them up and reach out directly there. But I think there could be other platforms we look on making them implementable on, but we have a strategic relationship with Quorus. So I think the best, in terms of the best terms of how you could get it with the least friction,
Right.
we'll probably start with Quorus. And I think we look forward to the collaboration and making it more broadly available.
Yeah, and I think that's an important thing to know. I haven't have worked for and know some of the other platforms that do the model marketplaces, and most of them you have to do all the trading and implementation yourself. You're just kind of taking the model off the shelf and then implementing it. And yeah, you get like the updates through it, but you still got to implement it. And Chorus kind of helps you do it a little more efficiently. So, worth considering, even if you're looking at these things in a traditional model marketplace, the additional efficiencies that Chorus brings to the table, I think, can't be ignored. What did we miss? What are you excited about? I'm going to see you in a couple weeks. What are you excited about with the markets? What are you excited about going into year end with WisdomTree? Tell us and our viewers like the things they should be paying attention to as we get into the end of the year.
Well, there's a lot happening in the markets. I think as we're talking, the week of one thing that made us popular was we talked about capital efficient, adding things on top of. We became very famous for taking things off of things. Also in the international markets with currency, you had this Japan news over the weekend that you got a new prime minister. You had Shinzo Abe really changed the direction of Japan. 13 years ago, came in 2012, and broad international markets. I was just looking this up this morning. Have done 7.5% when the S&P did 14.5%. Right. So if you compound that for 13 years, that difference is dramatic. You say, well, how many things were able to keep up with the S&P 500 since Abe first came in? I'll tell you something that beat the S&P 500, which is our Japan currency hedge idea. And so there's been something, and that not most people don't aware like how much the currency was a problem for Japan. We've got new Abe, Sana Takaichi, who came in, is going to be the new prime minister. And she's viewed as Abe 2.0, the first female prime minister in Japan, with a very aggressive fiscal spending, defense hawk proposition, changing Asia. And I think that it's been like a U.S. market for so long. International has been, U.S. exceptionalism is the main narrative. International could be, there could be some cases for going international as well. And I think Japan is one of the things that's hot, I think, over the weekend, and going to be looking forward. I mean, it's been one of my favorite places, but I still think it's one of my favorite places. So that's an interesting one. And we're going to continue to do more capital efficient ideas. I think on the roadmap, that is where we're spending a lot of energy. So you're going to see more interesting things from us before the year end, into new year. There's a lot that we're doing with that concept. So more to come. And I think more to come on the SMAs and models. So I think this is a great start for the two of us.
Yeah, absolutely. It's exciting. I think I saw something earlier today that we're starting to see non-US markets outperform in like the recent weeks in a meaningful way. And what does that mean? And a lot of things are cyclical, right? And if you look back over history, there's like 10, 20-year periods where one outperforms the other, but they usually do flip. I know when I started my career, and it sounds like around the same time you did, international markets were outperforming, broadly speaking, most of that time until EM blew up in like 07, and then everything kind of switched. But these things are not, they are fairly cyclical, and they do change over time. So I'm going to have to take another look at Japan. Haven't looked at Japan in a long time, but
nobody else has either. So there's been like 100 billion that went international. 0 went into Japan this year. So it's under loved for sure.
Cool. Well, thank you so much for your time. I really appreciate it. I am super excited about the partnership with WisdomTree. Really excited that we were able to get you on the podcast so we could talk about it. If anybody wants to get in touch with WisdomTree or Jeremy and his team to learn more about what they're doing, I'll make sure to include your contact information in the show notes. He mentioned a couple books. We'll put those in the show notes as well. But that is it for this episode of What's the Alternative? I am Shana Orczyk Sissel, founder and CEO of Banríon Capital Management. And as always, remember to hit that like and subscribe. And if you have ideas or individuals that you want to hear from, put it in the comments. We would love to hear what is top of mind for you so that we can bring you content that challenges you and that helps you think about markets more broadly outside of the traditional stocks and bonds. The opinions expressed on the What's the Alternative podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or in any specific security. This is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this podcast is no guarantee of future results. The guests featured on this program are participants on Banríon Capital Management's platform. As such, Banríon may receive payment for their participation as a platform partner. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed investment professional. Investments are not FDIC insured, nor are they deposits of or guarantees by a bank or any other entity, so they may lose value. Investors should carefully consider investment objectives, risks, charges, and expenses. This and other important information is contained in the fund prospectus and summary prospectuses, which can be obtained from a financial professional and should be read carefully before investing. Statements attributed to an individual represent the opinions of that individual as of the date of the published podcast and do not necessarily reflect the opinions of Banríon Capital Management or its affiliates. This information is intended to provide educational value, highlight issues, and should not be considered advice, an endorsement, or a recommendation. All Banríon Capital trademarks mentioned are owned by Banríon Capital Management, Inc., an affiliated company, or its funds. All other company and product names mentioned are the property of their respective companies.